Hey everyone, this is Addy again. So today I'm doing this video to basically do a very basic options trading 101 from opening the account to actually putting a position on. That's what we are going to discuss today. Like if somebody's like brand new to this space, how to even get started. Now here's the step by step on it. I know there are thousands of these beginner videos like trading options 101, ultimate, whatever rubbish that is. But this is what you need to know in order to start trading options and actually to put a trade on. Now, first of all, what would I recommend? I recommend you go out and open up an account at Schwab, which has recently bought the best trading options trading platform which is out there called TOS, Think or Swim. It was built by derivatives traders. Um, Really nice platform. Trust me, there are no commissions coming in. This is just a free channel, and I make videos on it. Okay, these are the levels that you need to be approved for in order to trade the strategies that we discuss. Now, what's going on here? So you definitely need level one approval. Level zero means you open up the account and you have some stock in there, or you have a lot of cash sitting in there to write these puts. Um, Level one will give you the functionality or the option to trade long options, meaning buying an option. And in this video, I will show you today how to buy an option, how to sell an option. But our primary uh, mantra is basically to sell options. But in order to do that, you need to know how to buy options, first of all. You need to know the four sides of it, meaning long call, long put, short call, short put. And we are going to discuss all four today. Anyway, you need at least level one to do any kind of, you know, to make any kind of long trades. Then you need level two in order to do spreads, meaning you buy one option, you sell you sell the other one. And then the final level is basically you they call them naked options, meaning you sell both sides of the market naked. There is no protection anywhere. Um, and these are some of our very profitable strategies. When you sell both sides of the markets, I will show you in a straddle or a strangle. These are the most profitable trades, highest probability of profit available out there. Anyway, so now you know. Open up an account at Schwab, download Thinkorswim. It looks like this. Download the desktop platform, download the mobile platform so um, you can track your positions anywhere. Download an iPad as well, whatever, however many you want to download. I normally trade on my desktop platform. I like that best because I can look at the charts. Everything is right in front of me. Every other platform out there is nowhere near as good as this one. Anyway, why am I banging on about TOS? It's because I like it. I've been trading on this for the last 8 years, and I have not changed at all. Down below here, you will see no other platform. My live positions are on TOS. My paper trading account is on TOS. Then the next thing is you need to go into your paper trading account. See on the top left, it says simulated trading. That's where you need to be. I have a margin account. That's what you will have as well. Eventually, you'll have a level three where you would be able to sell the options naked on both sides. Um, but first of all, you need to know how to buy an option. So we just discussed a very simple strategy um, on how to do it. Anyway, now at least you know which account to open, which thing to download, and where to go. Create a watch list. Create a watch list of stocks, indices, forex, commodities, whatever you like. On the left hand side here, that's all I have. I don't have any news coming in. I don't have any live feeds coming in. Those are just distractions to me. For me, volatility and price are the two most important metrics to make a trade and to manage a trade and to close it. Anyway, to keep the video really, really short, let's go to the trade tab here. I'm going to keep marking it so that you know exactly what I'm doing. Trade tab. Now also, make sure you have this red sign linked to both sides here. You look at this. This means as soon as you click one of these watch list items, it will appear in your trade tab. And you have to do the same for your analyze tab, and you have to do the same for your any of the tabs that you want the same ticker to appear on. For example, charts or tools or fundamentals. Wherever you look, if you want to look at the fundamentals of the stock, just make sure there are more color options here. I just choose the first one, red. No particular reason for that, but that's what I have. I've never changed. Anyway, Apple. On top, you will see one more thing. Set up your option chain to show all these things. These are the most important things I have. You can do whatever you want. There are some preset ones here which you can choose from, or you can customize. I have customized it to these metrics. These are the only things I look at. There's plenty more, but I don't really look at those. I don't need to. Everything is given here. Sometimes I will look at probability of in the money, which I already have. Double click it. It comes on your right hand side, and then that's it. We don't need row. We don't need theoretical price. We don't need size. We do have vega. We have theta. We have delta. But the important ones there. Anyway, okay. When you open an option chain, here, make sure this is selected to all. Again, this is important. You want to see all the strikes. There's an option to select less, 14, 12, 10, but I always look at all of them strikes, all the strikes. Anyway, next thing, how do you look at the option chains? These are the weekly options, the yellow ones, and then the gray one is the monthly option, meaning it will expire on the third Friday of the month, which in this case is 20th of September. Now let's go and check what 20th of September will be. On this side, I have September 20th, Friday. So that's the third Friday of the month, right? So the monthlies will expire on the third Friday of the month for all underlying instruments. Well, for stock and indices for sure. I think futures options do the same thing, but we can visit that later. Anyway, when you buy an option, always remember we are sellers of these options, but you need to know how to buy the option first. So you will go to at the money strike, which is here. Always when you buy, you will buy at the money. You do not buy out of the money options, even though these are expensive, but they have the higher probability of being in the money or making you some cash on expiration or before. If you buy out of the money options, you have a very small chance of successfully winning on that trade. Reason I say that is because look at the probability of in the money, meaning what is the probability of these option strikes to be in the money on expiration given current volatility levels around 26 for Apple. Here's the current vol level. The highest probability is for the at the money or in the money. There it is. Because when we sell options, we sell out of the money options around 17 deltas. So we would sell this one. But when we buy options, we buy this one at the money because this has the highest probability of success. That's what we look for. We are mathematicians by default, by trade. So we look at numbers. We don't just go out and do not buy out of the money options. Period. I don't do that. You can do whatever you want to do, but that's how I trade. I don't buy options. I don't buy options full stop, but if I have to, I would buy an at the money option because we sell out of the money, right? We sell the options which have the lower probability of being in the money at expiration. Anyway, how do you buy an option? When you buy something, you have to click ask. You are asking for a price. Look at the bid-ask spread here. It's 5 cents. This is nothing. Apple is really liquid. It's a very liquid stock. So always click ask. Left click. Change this. You can change this in settings. So for your default number to be 1. When you're starting to trade, always go with 1. And then right click and analyze. Now what's happening here? You are basically paying a debit of $4.75 to buy this option. Now, if you look at the other options that are available, they are cheaper. If you go down the list here and we are buying a put option here. Well, actually, let's go and buy a call option because most people understand the call side better. So I'm going to buy this option, which is $225 strike. Ask $6.65. Now you can clearly see the difference. This is what's called call skew. The same strike has, and because there's dividend built into this, There's a lot of factors that go into it, which we can discuss later, and that is the reason why the call price is higher than the put price. At the same volatility, same strike price, and same everything. But there's a lot of other things that go into these pricing models, um, which then throws out this number, which is $6.60 for a call, $4.75 for a put. Now, if you look at the SPY options, it would be the reverse. Let's look at a SPY option. How many days out? We are 23 days out, right? Let's look at a SPY option. Basically, any chain in SPY, I think would be the same thing. So let's look at this here. Now, SPY is because people hedge with puts. Look at the volume and open interest here on this side. You've got a lot of it on this side too. People, this is a very liquid stock. It's the S&P 500's ETF. So here, 555, usually what you would see on this side is the put side being more expensive than the call side, especially for out of the money options. Now let's take a look. So let's take a look at this 30 deltas here. Let's see if I'm right based on this current volatility levels. 30 deltas. Here we're looking at 30 deltas. The option is $4.52, which is at 545 strike. So I'm looking at this number, which is $10 away from at the money, whatever the price is right now. $10 away, right? Now let's go $10 up. From 555, we are going 565. $4.13. There you go. At at 30 deltas, the deltas are slightly different. It's 34, but I'm just going dollar amount, right? I'm going $10 down, $10 up. You can clearly see the difference. 411 for a call, and where was this one? 453. So it's more expensive, right? Because people buy put options in major indices, in overall index products to hedge their portfolios. That's why these put options are used as insurance, and that is why there's always a higher bid in these put on the put side versus the call side on index options, not stock options or other ETFs. But anyway, let's get back to Apple. Fine, we're going back to Apple. 23 days out. We're buying this call option at the money, 50 deltas. I can see the deltas here. Actually 56 deltas at 225. That's the one I like. I'm going to do that. And now let's just analyze this trade. I'm going to go back to one. Okay, the video is already 12 minutes, so we need to speed this up a little bit. Well, this created a straddle. I don't want that because straddles are the same price. I'm going to cancel that. We already have this. So how does this payoff diagram works? You paid $6.65 to get into the trade. That's how much money you are paying to basically initiate the trade, meaning your stock price needs to first go up by $6.65 for you to cover the debit that you're paying. It's a debit. You can see you're buying an option, and once you right click and send it, confirm and send it, you will see that this is the debit that you're paying. Now, how is the payoff diagram working? Let's see. Where are the break evens and where are the? I mean, I could have done this on a PowerPoint as well, but I'm not a PowerPoint guy. I'm a visual person, so I'd rather do it on the platform. So the strike is the stock is trading here, 225, and then you've paid $6.65 more debit, meaning your break even on the upside is now $231, meaning the stock price has to beat the 665 number first before it even starts making money for you. And the further up you go, the more money you make based on the deltas you are carrying. You are carrying 50 deltas here. You can see it here, 56 deltas. Long options have long gammas and long gammas and long deltas. Short theta, meaning this is the amount of money you will lose every day to hold this position. $13.43. You will keep on losing this. Vega, it's long Vega, positive Vega when you buy options, meaning that the volatility has to go up from here for you to make money in this trade. Anyway, next thing, we just convert this into a put option, and then I'll show you the put side. And make sure you always click this number because the puts are not trading at 665. They're different. They're 475. So now on the downside, your break even has moved further away. from 225 down to minus 470, whatever debit you pay. So it's like 220 now, around that number, ballpark. Only after that, once the stock drops by $4.75, $4.70, then you start making money in the trade if the market keeps going down on you. If it doesn't, then you will start losing. You're already losing $10 on this trade every day anyway, in terms of theta. Theta, these are decaying assets. Options are decaying assets, right? So remember, they decay every single day. Closer they get to expiration, closer they get to zero. They have to get to zero, or whatever number that is. They have to lose all their value or make all the value by expiration. Um, Buying a put is negative deltas. You are carrying 43 negative deltas, meaning each dollar move, you will make $43. On the call side, for each dollar move, you were making $56 because we were carrying positive 56 deltas. So you make 43, but then you lose 10 on a daily basis. So that means your net 33. Plus, if the volatility goes down from here, you will lose on the Vega as well. So net it's a decaying asset, like I said. So we don't do this. Now let's stick to the same thing and bring in the short side of these. That's our bread and butter. That's what I like doing. Let's sell a put. Let's sell a put option at 215. Why did I not choose 212.5? Look at the volume and open interest here, compared to the one before below that and one above it. You see the difference? Half strikes are not really traded that often. So do not buy. Do not trade half strikes, especially in the stocks and regular ETFs. Do not trade these. You can go down and check all the open interest and volume in these half strikes. They will be definitely lower than the full strikes, the full whole numbers. The whole numbers, let's say $200 whole number. Look at the open interest and volume number, thousands, right? Anyway, back to our short option strategy trade. We are selling a single. We can do any of these. I can teach you all of these strategies one by one, but this is because this is a beginner class. We're just trying to set up and understand the platform, the trade mechanics, how to look at the charts, what to set up as. Sorry, we're not doing a vertical here. We're doing a single. When we sell a put option, do a sell. Always change this to 1. When you're trading, well, this is a paper trading account. You can do 2 or 3, however many you want. But mine is my go-to size is 1. Okay, look. Now this is the option. This is the probability of profits I want to show you. 98% probability of profit. Hold on, let me just double check one more thing. 921. No, so that's wrong. So break even, go to break even, select your expiration cycle or expiration date. Make sure you select the same thing here on top. And that's when your chart will become, it will show you the right numbers. 81%. That is correct. This is the number we like. 81%. Fine. Now, obviously, there's a bigger down payment to make when you sell short options. You have to cover these stocks. Now, this is a bigger down payment of $3,400. We can talk about that. When you buy options, you just pay the debit. So for the calls that we were buying at 660, at 665, whatever, we were only paying 665 plus the option commission of 65 cents per contract. When you sell options, you will have to make sure that you can cover, because when you sell the put side, you can be put the stock. So at expiration, if you are out of the money, the buyer of the put option will bring up a bag full of stock, Apple stock to you, 100 shares, because you're selling one, and give you that bag of Apple stock and take the cash from you. So you need to have that cash because you can get put the stock. So always remember, you need to cover your stock with cash when you're selling naked options. Now spreads are definitely better. It's less buying power, less everything, but we can, and those options move differently too. I did not show you the debit side, the payment side of the call option. Let me just bring that up again. So I'm going to take this in. I'm going to take this to, change this to 1. And then let's do confirm the sign of this. So you're only paying $665 plus 65 cents for the contract. TOS will charge you 65 cents to trade each contract. If it's a double-legged trade, meaning you have two options in one order, it will charge you 65 cents times two. And this is your buying power effect, meaning this is the amount of money that will be taken away from your account if you send this trade right now. Whereas on the short put side, the amount of money is more. It's still definitely not exactly to cover 100 stock, but in order to buy 100 stock right now at whatever our strike was, 215 times 100, you need $21,500. But this platform is charging you $3,400, meaning there's some margining involved here, right? What is that margin number? 3,400 divided by 21,000. 15. You're putting down 15% to trade the option, and then this margin will change. If the market goes against you, the margin will change. So remember that. This is not a set number. It will keep on changing. I don't know why I deleted that. I could just turn that into a call side, but let's see. Now we're selling the call side. You right click and you sell. You sell a single. Fine. Let's take this on our analyze tab. Again, always make sure you change the set slices to break even to your expiration cycle, and the top party change as well, 82%. Whatever your deltas are, this number will be the reverse of that. What this is showing you is you have an 82% chance of making money, of making $1 or 1 cent, of being in the money, of making money on this position. 82%. Now, if you look at that for the call, if I convert this into it's still a call. If I convert this into a buy, look, if I buy an out of the money option, look how my probabilities change. You go back here, you go back there. There is an 82% chance that the stock stays here and it doesn't go above it. Meaning, if it doesn't go beyond your break even, you will never make money. So the shaded region, it's currently trading here, and from here the stock can go. It has to cover your debit up to your break even. Then it has to move up. So that's the pros and cons. Those are the pros and cons of buying and selling. Where were we? We were selling a call. I'm going to change this into a sell. So that's how you do it. We trade with probabilities. You are connecting $113 here. This is the max profit that you can make, and then we normally look to collect 50 to 60% of this max profit, and then move on to a different opportunity, different product. So we've covered the platform side. We've covered the basic options, the basic side of these options, buying and selling. This is how you should practice. Keep on practicing. Do not start trading live until you've done at least 100 trades, both puts and calls, long and short. Make sure you do both sides, long and short. My next video will be on a spread to see how we can lower the buying power and make the spreads. Because that's what I primarily trade in futures options. That's what my number is. I trade call or put spreads. I'm on the contrarian side, meaning I sell the market when it's sell the puts when the market is down, sell calls when it's up. So today I'm looking for an opportunity in SPX futures options. Now look at the volume and interest, open interest here. Volume is slightly lower here because this is 51 days out. Maybe if you go to a regular, slightly lower one, not much here. The weeklies do not get much volume anyway. I think maybe this one will have more volume, 33 days out. Yes, this one has slightly more, still thousands. We like that. So if I were to set up a trade today, and this is what I would probably do in my real account. I'm going to go back. I'm 33 days out. This is enough time. Normally I select for 40 to 45 days, but the availability is not there. It's either these are weeklies, right? I don't want to touch these. So I stay in the monthlies, end of the month ones. This is fine for me. And then the next available one for me will be this one, the grayed out one. And then the one after that will be this one. But I want to go 79 days out. Doesn't make sense. Let's stick to 33 if I have to make that trade. We can also go into the 37 one. So look at the volume. I don't like it. I don't like the numbers. Look how we saw thousands in the other expiration cycles, and then you look at here. Always check here because you want to trade liquid products. You have to trade liquid products. Uh, you cannot go without trading liquid products. So always make sure you are in liquid products. Narrow bid-ask spreads. Anyway, what else? If I were to trade this, what would I do? I would go here, not in this cycle. Let me just select my correct expiration cycle. I can go 33 days, end of month, fine. And I'm going to sell a put because the market is down. You can choose your premium here. Look, down 1%. This is awesome. Volatility must have ticked up. Go into charts, look at the vol. It has gone up. Implied volatility is up. It is still not as high as I would like. So maybe I will wait until it pops up above 20. Above 20 will give me over average volatility in this product. This was an anomaly here on this side on August 5th. We all know that. Yen trade fiasco, wherever. Anywhere above 20, 25 is above 25. It has not been above 25 other than 3 instances the whole last year, going back one whole year from now. So I can sell something here at 20. Currently it is at 16. So if I were to trade, this is what I would do. Right click, and I always go $20 out in SPX options, futures options. So if we change this from 53, I'm selling at 53.60. I'm gonna buy 53.40. $2 credit, not much, because the overall credit, you have to divide this number by 50. By 2. It's just half of what you look at this here because of the multiplier on the index. I get good probabilities for sure, but I'm not getting enough credit. If I select 10-1, my probability number is really nice, 81, I like that. But I'm only collecting 100. Normally I would collect 125, 130, 140 in this product. But that is also because I go out and sell 45 days out, 40 to 45 days. This one is only 33 days out. So I'm going to keep looking for opportunities in other cycles. If I can find a better one in 51 days out, I will probably pick that one. 51 is a little bit too much for me. I like to cap it out at 45, 50 max, 45, 47 max. Let's see how much credit can we collect here. 52.70 at 17 deltas. I'm going to sell a put side and then change this number. And then change this to 52.50. Again, I'm only collecting $2, so not much different, man. Well, actually, it's trading at once. Well, it's gone back to up to 2. So I'm not going to touch this right now. It's not enough credit for me. I have to collect over $125 to be interested in this trade. And the reason for that is because I will pay, if you look at this confirm and send number, you will pay $4.50 to get in and $4.50 to get out. So that's $9 already gone, right? Plus, if you have to make any adjustments, you'll have to pay for that as well. So futures options are good for leverage, but they are not really that cheap to trade. But I trade them because I get a lot of leverage. So see, my buying power is only $240. I can live with that because I can deploy the rest of the capital somewhere else. I can do 3 additional trades for the amount of capital here versus doing a stock trade or an index option trade. Anyway, that's it for today. Let me know for any other basic stuff that you have to get started. Set up your charts. I forgot to tell you. Just set up your charts. Here's how you would set it up. On the day side, select either of these or go and select your own customized list. Select your time frames here. Add your time frames, whatever you want. I normally look at 1 year, 1 day. So I go back 1 year, 1 day. Now the reason I do not do year to date is because let's say if you're in January or February, you only have 2 months of data here, which I don't like, right? This is how your chart would look if you do year to date. If you do 1 year, 1 day, meaning it goes back 1 whole year from now, and it gives you the chart for the last 365 days. Studies, I don't have many. I just keep, even volume I don't need. I know, volumes are very liquid. These products are really liquid. Implied volatility is my number, is my chart to go to chart. So that's what I look at. I'm creating my own custom volatility indicator, which will give us a implied volatility number based on the market moves for the last one whole year. But anyway, it's not done yet. I'm getting it done. Style drawings, I don't really look at any of these. These are the expiration numbers here, the cycles, the futures when they expire. You can look at all these things. What else do I have? I don't have much here. Yeah, keep it simple. You don't want to complicate things. It's a very simple thing to do. Just set it up, create your watch list, go through these numbers, bring these columns in, look at these numbers, and then just put a paper trade on. That's it. I'll see you in the next one. Thank you very much.